Did you know that reaching $100,000 in investments means you're already 1/3 of the way to $1 million? Sounds surprising, right? But it's true. Today, we're going to dive into the fascinating journey of building wealth and uncovering how the first $100,000 sets the stage for exponential growth. You'll see why hitting that six-figure mark is such a game changer and how it makes the journey to $1 million faster and easier than you might think. So, are you ready to learn the secrets to turning your first $100,000 into $1 million and beyond? Stick around because you won't want to miss this. The late Charlie Munger, the legendary investor and vice chairman of Berkshire Hathaway, has given a lot of wisdom over the years. One of his most famous pieces of advice is about reaching your first $100,000. He said, "It's a bit, but you gotta do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. So why is this milestone so critical and challenging? Initially, your investment returns are tiny because your principal amount is small. This means that most of the growth comes from your own pocket, not from the investments themselves. Plus, early in your career, you're likely dealing with lower salaries, student loans, and other debts that make savings tough. Let's break it down with an example. Imagine you invest $100 a week with an average annual return of 8%. After 12 years, your total contributions would be $62,400. Thanks to compound interest, your investment could grow to about $102,502. Most of this growth initially comes from your contributions, not the returns. It's a slow process that requires patience and consistent investing. But the journey to $100,000 isn't just about finances, it's a mental game too. People love round numbers, and there's something psychologically satisfying about hitting that six-figure mark. While there's no magic switch that flips at $100,000, it feels like a significant milestone compared to $99,999. It's a clear marker of progress. Getting to $100,000 usually involves earning promotions and salary increases, significantly cutting your spending, or taking on side gigs like driving for a ride-hailing service or freelancing. The key is to boost your income while minimizing expenses. Moreover, consistency is key when it comes to saving your first $100,000. One of the best ways to remain consistent is to adopt a set-it-and-forget-it approach with automated savings. Set up recurring deposits into your savings or investment account on the same day each week or month. By automating your savings, you remove the temptation to spend money you intended to save, and you steadily get closer to your goal without thinking about it. Also, keep in mind that the journey won't always be smooth. Unexpected expenses may arise, forcing you to dip into your emergency fund. You might decide to invest in major life changes like pursuing a graduate degree or planning a wedding, which can be costly. It's okay to take a few steps back. What's important is to keep moving forward and resume your savings plan when you can. Once you hit $100,000, compound interest starts to play a bigger role, making it easier for your money to grow. But how does the journey change once you hit $100,000? Now that you've reached your first $100,000, the journey to $200,000 becomes much more exciting. This is where the power of compound interest really starts to shine. If you keep investing $100 a week with an average annual return of 8%, it takes just another 6 years to double your investment to $200,000. This period showcases how compound interest accelerates your wealth building journey as your investment base grows. Let's break this down. In the first 12 years, you contributed a total of $62,400, and with the magic of compound interest, your investment grew to about $102,502. That's $40,102 from interest alone. Continuing the same strategy for the next 6 years, you'd add another $31,200 in contributions. At the 18-year mark, your total contributions would be $93,600. $62,400 from the first 12 years plus $31,200 from the next 6 years. But your investment would now be worth around $202,281. That's right, compound interest has added approximately $108,681 to your investment. Notice how in just the next 6 years, your investment grows by nearly $100,000, almost matching what initially took you 12 years to achieve? This exponential growth is the real power of compound interest in action. Now, just in case you don't understand more about compound interest, let's get into more detail about this snowball effect that makes your money grow faster. Compound interest is often called the eighth wonder of the world, and it's clear why. This powerful financial concept allows the interest you earn on your investments to start earning interest itself, leading to exponential growth over time. Unlike simple interest, where you earn interest only on your initial principal, compound interest means you earn on both your initial investment and the accumulated interest from previous periods. This compounding effect can significantly accelerate the growth of your investments, especially over long periods. To illustrate this concept, Warren Buffett, one of the richest individuals in the world with a net worth of $139 billion and the ninth richest person globally, simplifies it beautifully. He compares compound interest to a snowball rolling down a long hill, gathering more snow and gaining momentum until it becomes a massive snowball. Now, let's break down how contributions and interest work together over time. When you invest money, each period, whether it's a year or a week, generates returns based on the current value of your investment. These returns are added to your principal, increasing the amount generating returns in the next period. Over time, this cycle repeats and the money generated from interest grows larger and larger. For example, if you invest $100 per week with an average annual return of 8%, your investment will grow significantly over the years. Initially, most of the growth comes from your contributions, but as time passes, the interest earned becomes a more substantial part of the growth. This exponential growth is evident when comparing the journey to $100,000 and $200,000. It takes 12 years to reach $100,000, but continuing the same investment strategy leads to impressive results. After 24 years, your investments grow to approximately $360,619, more than tripling in the next 12 years. This highlights the accelerating effects of compound interest. By 36 years, your investments reach about $1,010,601, surpassing the $1 million mark thanks to compound interest. Reaching $200,000 means you're halfway to $1 million in terms of time, but not in terms of contributions. The power of compound interest doesn't just lie in the numbers. It also underscores the importance of starting early and maintaining a long-term perspective. While Buffett is an exception, he bought his first stock at age 11. Compound interest leverages the power of early action, time, and will, which are fundamental to success. The key to Buffett's success is long-term thinking. As he famously said, he knew he would become wealthy, But he wasn't in a hurry to get there. This patience is evident in the wealth of Berkshire Hathaway, which has held onto some stocks for close to 30 years, emphasizing the importance of value growth over time. Remember, compound interest doesn't discriminate. Of course, the more money you start with, the more you'll make over time. But you don't need to start with a lot. You just need to start. Regardless of your bank balance, job, or background, anyone can build great wealth with time and consistent investing. Reaching $1 million in investments is a huge milestone. But what's even more exciting is what happens next. With the power of compound interest, your investments can keep growing exponentially, allowing you to hit $2 million and beyond. Let's stick with our investment strategy. $100 per week with an average annual return of 8%. After hitting $1 million in 36 years, your investment doesn't stop there. It starts growing even faster. By year 45, your investment can grow to approximately $2,087,646, showcasing the incredible potential for continued growth. The key to this rapid growth is the significant return increase after reaching $1 million. With a larger investment base, the amount of interest earned each year skyrockets. For example, if you have $1 million invested at an 8% annual return, you would earn $80,000 in interest in just 1 year. That's nearly the same amount it took to reach your first $100,000. The impact of earning substantial increase annually is profound. Once your investment starts generating significant returns, growth becomes almost self-sustaining. Each year, the interest earned is reinvested, further increasing your investment base and the potential returns for the following year. But in all this, you need financial discipline. Financial discipline is key to achieving long-term investment goals and harnessing the power of compound interest. Consistently following a set investment plan is crucial for building substantial wealth over time. Regularly setting aside a fixed amount of money for investments, regardless of market conditions, ensures steady growth in your investment portfolio. This approach also takes advantage of dollar cost averaging, which reduces the impact of market volatility. You buy more shares when prices are low and fewer when prices are high, balancing out the cost over time. But where can you find those extra funds to invest regularly? Small adjustments in spending can lead to significant financial growth. For instance, cutting back on non-essential expenses like dining out or unnecessary subscriptions can free up more funds for investment. Let's look at a simple scenario. By saving an extra $50 per week through small spending adjustments and adding it to your regular $100 weekly investment at an average annual return of 8%, you can see substantial growth. Over 30 years, this combined weekly investment of $150 can grow to approximately $917,821. This example shows how small changes in spending habits can significantly boost your financial future. However, financial growth isn't just about making smart spending choices. It's also about cultivating the right mindset. Developing a disciplined and forward-thinking approach to money management is crucial. This means viewing every dollar saved as a step closer to financial independence and long-term wealth. By cultivating a mindset focused on consistent savings and investing, you can overcome short-term temptations to spend and instead prioritize your future financial security. This shift in perspective helps reinforce the importance of financial discipline and its long-term benefits. So, stay disciplined, make those small adjustments, and keep your eyes on the prize. Your future self will thank you for the financial security and independence you've built through consistent and disciplined investing. Now, we'd love to hear from you. What's the first step you're going to take to reach your $100,000 milestone? Or, if you've already hit it, what strategies helped you get there? Share your thoughts and tips in the comments below. If you enjoyed this video and found it helpful, make sure to give it a thumbs up and subscribe for more insight.